Hi, Niro Pillay here from Investment Rise, and in today's video I want to talk about what the banks increasing their rates outside of RBA movements means for you and I. You see, last week I put out a video where I said that I expect going forwards banks will pretty much disregard most RBA notions and start increasing their rates outside of any RBA movements. I figured it would happen early in 2017 after the new year, but just earlier this week, many of the banks came out and made an announcement that probably puts coal in a lot of people's Christmas stocking because they talked about increasing rates. Sure, some banks said they're going to limit it to investors, but others said they're going to increase them across the board. So what does that mean? Well, the first thing is, let's divide up the various groups of people who are affected by rate rises. The first one is your savers. So if you're someone who believes that you can go to work, earn money, pay tax, pay all your bills, and then put your money in the bank and save your way to wealth, I'm afraid it's going to become even more difficult. I would say it's pretty much impossible now if it hasn't been for quite some time. And the reason is this: when the RBA, Reserve Bank of Australia, when they increased their rates, all the rates on all the products increase, which means that not only do home loan rates increase, but the rates on your savings increases as well. However, when banks start acting outside of interest rate, or rather RBA interest rate movements, start increasing the rates on their own, they're only increasing the rates on the products where they make the most amount of money, which are home loans. So what's happening is that if you're saving, you're not getting any extra in your savings, but the interest rate on your home loan or your investment products, they're all starting to rise. So you're being left further and further behind. So definitely, if you're planning on saving yourself to retirement, having a wealthy retirement through savings, it's essentially going to be eroded. Second of all, our homeowners, people like you and I, you got a mortgage and you're trying to pay that off as soon as possible. Banks increase their rates. Now, you're still earning the same amount of money, you're still paying the same amount of tax, but probably your biggest expense, which is your home loan expense, has increased, which leaves you with less. So, homeowners are going to lose. What about the people then who say, okay, great, interest rates are rising, prices are going to fall, and now I'm going to jump into the market. The people who are waiting for the market to crash. Unfortunately, many of you will probably end up being like the property guru who I won't mention in 2012, who said prices in Sydney are going to crash. And to prove it, he sold his Surrey Hills property, took the money, put it in the bank. Had he waited 4 years, he'd have probably had an extra $300,000. Now, I'm not saying that's going to happen going forwards, but what I am saying is that Sydney prices have never crashed. There have been certain dips, sure, but we've always recovered. And if you've seen any of my videos, although I say now is not the time to be entering and buying property in Sydney from an investment perspective, if you already got property, you should be okay, especially if you own it for a few years. So the market's not going to crash. Why? Because even though interest rates are rising, we are still in a very low interest rate environment. Our interest rates are at record lows. So even though it's not the absolute record low from a banking perspective, it's still incredibly low. And there was recently a report which said that 25% of homeowners are at least a year ahead of their mortgage. So if you're a year ahead and rates increase a little bit as they have, yes, it causes a little bit of pain, but you're not going to have to sell, or you're not going to fire sell your property just to get out. So prices won't crash even with these rate rises we're seeing. See, the RBA is in fact quite happy that banks are increasing their rates outside of their own movements. Why? It takes the pressure off them. They don't need to then use their essentially only instrument, which is pretty blunt at the moment, that's their RBA interest rates, to be able to control inflation and prices and everything else. And what they're really happy with is that when banks start increasing their rates, even though there's not going to be a crash, our two highest priced markets, Sydney and Melbourne, will almost certainly start to cool and go flat, just like they have done after every other boom cycle that they've been through. And then people start looking to buy other things, people start looking to invest in other markets, and those prices start to rise. In other words, the RBA is saying they get to share the love. All right, so RBA is quite happy. So savers, homeowners, people waiting for a crash, unfortunately, all of you guys, if that's you and you're in that position, there's no winning here for you. But there is one group of people who are going to win. And that's property investors. Now you may say, like, Niro, how does that make sense? I mean, if you're a property investor, you've got a home loan, and investment loans are going up across the board. How can you be a winner? Simple. If you're an investor, your interest rate expenses are tax deductible. Now I know we don't invest for tax purposes, but the government gives you a buffer against interest rate movements through giving you extra back in your tax. So that's number one. Number two, as interest rates rise, and I said a lot of the banks increasing rates on home loans as well, less people are going to start buying and more people are going to start renting. And if there's more people renting, unless there's a massive onset of supply like in the high-rise apartment market in Sydney, Melbourne and Brisbane, all right, so let's take that out of the equation here, but across the country, if more people start renting relative to supply, rents start rising. And as the investor, the increased expense that you've had on your interest rates is now being offset to a large degree by the tax benefits and by the increase in rent. And then the other thing is, if more people are renting, vacancy rates come down, which means it gets easier to get your property rented, and when vacancy rates drop, rents generally rise as well. So I really believe right now that it's the time for the smart investor. With rates starting to rise, banks playing funny games to literally make more money regardless of what they say. That's their aim. They've got to report through to shareholders. It is a time for the investor. So if you're renting right now and you've got money in the bank, that's not doing anything for you. You obviously want to keep saving as much as you can, absolutely. But once you get to 50, 55, 60,000 and more, you want to be looking to take that money and invest it, so you're getting a better return. Saving is just the first part of the game, but if saving is all you're going to do, as I said earlier on, with this new environment we're entering, you're going to be losing. And if you've got equity in your house and you find that your mortgage on your home is going up, sure, you can fix the rates, but then it makes it very difficult for you to refinance, which is what the banks want, very difficult for you to tap into equity and buy an investment property. So what I'd be looking to do is say, okay, you've got equity in your house, look to use that to get an investment property that's cash flow neutral. If you watch any of my videos, you know that one of our driving philosophies at Investment Rise is buying property that costs you no more than a cup of coffee a day. So it shouldn't be affecting your lifestyle, and if anything, it should be costing you nothing, and hopefully even putting some extra money into your account every month, which therefore means it'll help, the investment property will help you pay down your mortgage. So that's really where I think the fact that banks are now starting to essentially be cowboys, and they probably already have been, but now it's to a much larger degree. They're able to do whatever they want, and acting outside of RBA movements for whatever the reason is. It's going to change the way we need to look at our financial situation, and you've got to start looking at whether you're in the investment game. Are you getting ahead? Don't let your money be lazy. Don't let your equity be lazy. Put it to good use and really look to what's the right strategy for you from an investment perspective. Hope this video helped. I hope it opened up your eyes to what I think is going to happen in the market over the coming few months with banks doing their own thing. Let me know your thoughts in the comments fields below, and I look forward to hearing from you. Bye for now.